coming. Thanks everyone for being here, and thanks everyone for taking the opportunity of having a little bit of a discussion. The ones on the cheap seats can come to the front if they want. There's no problem in getting closer to me here. I hope that the people that are watching us right now on Facebook, hello, are listening properly. And I hope that everybody here is interested about the topic that we're going to discuss today. The topic that we're going to discuss today is about this book, Escape from the Central Bank Trap, and is what is going on right now in terms of monetary policy. And what monetary policy means is central planning. And the idea that through monetary policy, imbalances in the economy are going to be solved is very interesting, is certainly very appealing, but is radically false. If you think about why, the reason is very simple. The economy is impossible to be central planned, and the more that you put all the perverse incentives into one single area, that is going to create further imbalances. The environment in which we live right now is an environment in which very few people would understand why, with such alleged high liquidity and such low interest rates, there are so little incentives to invest further, and why citizens perceive that we are in a situation that is generally bad. Here in the United States, Donald Trump won the elections saying that the job market was the worst job market ever, with almost 4% unemployment. And the reason why citizens see those problems is because in many areas they're actually right. Is because throughout the last 8 years in particular, we have seen the most aggressive experiment in monetary policy ever seen. Just to think about it, the United States between 2008 and 2016 has created more money than in all of its entire history. We have seen, the people that are here in this room have seen more than 600 rate cuts. Today, we are talking about the risks to the economy of the Federal Reserve raising rates by 25 basic points, with the idea that is almost like a cataclysmic event, when we have seen interest rates go down to the lowest levels in all of its history, in all history. So one of the things that we're seeing is the effects of malinvestment. Malinvestment is something that central planners are not concerned about. Why? Because the central bankers, governments, are not worried about whether you invest $1 into something that is a business, or that is an activity that is going to generate a good return on invested capital, or that is going to generate better growth or better returns in the future. The main objective is credit growth per se. When you go to the Eurozone, when you talk with the European Central Bank, the European Central Bank is not concerned about the fact that they are seeing right now more than 80% of investment in the Eurozone is just recycling of capital. Why are they not worried about it? Because GDP, as you all know, you are all students of economics, I believe, GDP is the easiest measure of something that is completely impossible to measure. It is the combination of things that you spend with things that you earn. It's the only economic principle in which you include things in which you are spending and things that you're earning. And the thing that creates more GDP than any other is credit, and is obviously higher debt. That's why lowering interest rates and increasing money supply are not tools to deleverage, are not tools to reduce the imbalances of the economy, but to perpetuate them. It is not a surprise that as we speak right now, the Bank of International Settlements is talking about the highest increase in zombie debt in the last 25 years. The number of zombie companies that are quoted right now, quoted companies, so large companies, is more than 9% of all the quoted companies just in the Eurozone. In the United States is a similar percentage. So what we have seen is that lowering interest rates has not done a favor to the economy, but has just perpetuated overcapacity, incentivized debt, and increased the imbalances that generated the crisis in the first place. So the way in which central bankers, in which governments have decided to tackle the problem of high debt and high risk and risky investments in the economy is by incentivizing higher debt and more risky investments. Instead of looking at ways to reduce those imbalances, what we have done is to look for ways to perpetuate them. As we speak right now, there are more than $6 trillion of negative yielding debt all over the world. Negative yielding debt means that you are paying somebody for them to borrow money. Negative yielding debt means that you are giving somebody $100 that they borrow, and they give you back 99 and change sometimes, not a lot of change. So imagine what this means. It means that we are completely breaking the understanding of what money is and the understanding of why money has to have a cost. Obviously, governments all over the world are saying that they are very excited about the idea that they're borrowing at the lowest yields ever, of course. But that does not mean that it's a good thing, because that comes at the expense of something. Okay? Governments are financing themselves. If you go today to the Eurozone, you have 19 countries that are financing themselves at less than inflation. That means that goes against somebody. What is against who is losing out of that? Savers, salaries, and obviously the competition for credit, because if a government is able to finance itself at much lower rates to perpetuate its imbalances, to increase deficits, to borrow to pay current spending, what ends up happening is that is detracting credit from the real economy, from good businesses, from good companies that might need that money. When we also disguise the true cost of money with extremely low interest rates, something happens as well. What happens is that citizens all over the world don't react the way that central planners would like them to react. What does that mean? You lower interest rates, you increase liquidity. What does the central planner want you to do? The central planner wants you to spend more, borrow more, and invest more into the economy. Yet, in countries like Japan, here as well, consumption is not increasing as much as they would want to, inflation is not rising as much as they would want to, and investment is not as high as they would want to. And why is that? Are people stupid? Here is the inherent problem, is that although you might disguise the fact that money has a cost, citizens, whether they're economists or they know about economy or they know what is going on, they do understand that something is not right. They do understand that despite the fact that there is enormous liquidity and despite the fact that there are very low interest rates, it is not a good time to borrow more. It's the situation that happens, for example, in Japan. Japan is a country that has extremely low unemployment, very, very high liquidity, massive injections of liquidity from the Central Bank of Japan, and massive increases in money supply, massively low rates, yet Japanese citizens consume a lot less than what the central planners expect them to, and Japanese companies invest a lot less. Are they stupid? No. What they don't have is amnesia. They know that despite the fact that interest rates are low, they know that despite the fact that there is massive liquidity, there are many other risks that are being disguised by those two factors. And citizens behave precisely in the opposite way of what central planners want them to behave. They don't take more risk, they don't spend more, they don't invest more, they are more prudent. And by being more prudent, then inflation, or at least the gauge of inflation, CPI inflation, doesn't go up. But all of that money, all of that liquidity is generating a very aggressive level of inflation. Where? Inflation is always a monetary phenomenon. Inflation is always a monetary phenomenon. But prices are not just what comes up in CPI. We are seeing massive inflation where? In financial assets. We are seeing massive inflation where? In house prices. We are seeing massive inflation where the money goes. The same way that if you are the Central Bank of Argentina or of Venezuela, you print pesos and bolívares, and that creates ginormous inflation. When you're printing money the way that central banks do in the Western world, it is actually what you're doing is printing credit. The central bank, what it's doing is leveraging itself up. That is basically creating debt that will be repaid with more inflation. However, as citizens don't behave the way that central planners expect them to, i.e. spending a lot more, investing a lot more, most of that money, most of that excess credit that is created generates inflation where? In financial assets. First, in sovereign bonds. Today, as we speak, with inflation in the United States here at 3%, the government 10-year bond is at 3.1. Therefore, it is basically financing itself at virtually nothing relative to inflation. That's a good thing if you're the government and you're borrowing. Is that a good thing for savers? Is that a good thing for the economy? Well, the problem is that the benign view of monetary policy is that, well, the economy is growing, unemployment is low, inflation is not high, therefore there is not a problem. What is it that we are so concerned about? Well, we should be concerned basically because the amount of malinvestment that is generated by those policies comes back to bite you afterwards in subsequent financial crisis. The first financial crisis comes obviously through a symptom. What is the symptom? Asset prices. Asset prices become more and more elevated, valuations become more and more elevated, there is a higher and higher risk built into the economy, and when that cycle turns, what ends up happening is that the impact is not only suffered by the ones that have invested in those assets. The impact is suffered by everyone, because the view of central banks that high asset prices and high equity market valuations are just sort of benign collateral damages to the ulterior motive, to the final objective of delivering a little bit higher growth and a little bit lower unemployment, ends up being a much higher risk than what they perceive. Imagine that you're creating a recipe now, and in that recipe you're cooking something, and within the recipe you have something that is burning in a stove somewhere in the background, and you don't pay any attention to that. You say that's fine because I like what I'm doing. Well, the problem that we're seeing right now is that after the financial crisis, what monetary policy has done is to fundamentally perpetuate the risk built in financial assets. And what happens is that as crisis after crisis, the tool of central banks has always been the same. First, lower interest rates. Second, increase liquidity. Crisis, lower interest rates, increase liquidity. Another crisis, lower interest rates, increase liquidity. Is that you get to a point in which you run out of tools. Even from a Keynesian perspective, the law of diminishing returns exists. And even if you give some sort of acceptable view of the impact of monetary policy on growth and jobs, you still have to acknowledge as well that the new measures, that the new policies that are implemented do not generate higher levels of growth and generate increasingly lower returns. The return on invested capital of monetary policy is diminishing. So every time that we enter into a crisis, we enter into a crisis with higher debt and with more risk built in financial markets. We exit the crisis by lowering interest rates and increasing liquidity, and we exit the crisis with even higher debt and more risk built in financial markets. Think about it this way. We are living today in what is called the bubble of everything. This is very funny. No? The bubble, if everything is a bubble, nothing is a bubble. No? But the bubble of everything means something different. What the bubble of everything means is that the lowest risk asset, which is supposed to be sovereign debt, is the most expensive of them all. And as such, it leads all other assets, almost like a domino effect, to be more and more and more expensive. And so we are today in an environment in which we talk about having exited the crisis, we talk about the path of recovery, and after the path of recovery, global debt is at all-time highs. Global debt exceeds 320%. Global debt not only exceeds 300%, so we have exited the crisis with more debt, but at the same time, we have also exited the crisis with much higher risk built in different financial assets. Not just houses, not just equities, not just telecommunications or technology. No, sovereign bonds. Now, think about this. If you buy a house that is too expensive and you've paid too high a price for it and house prices go down, you suffer a loss. If I buy a stock in a company, in a telecommunications company, and it ends up publishing a profit warning, I suffer a loss. What happens if the biggest risk, the highest bubble, the largest bubble is in sovereign bonds? Who pays? All of us. All of us. There is no escape from the bubble created in sovereign bonds. So the big risk of the messages that we hear out there is, okay, interest rates are at zero. Liquidity is at all-time high. The balance sheet of the main central banks, as we speak today, the balance sheet of the Federal Reserve is about 20% of the GDP of the United States. The balance sheet of the European Central Bank is about 41% of the GDP of the Eurozone. The balance sheet of the Japanese Central Bank is 100% of the GDP of Japan. The balance sheet of the Swiss Central Bank is 125% of the GDP of Switzerland. Now, think about this. Okay, let's imagine that there is a bump in the economy. Let's imagine that there is a crisis. What is going to be the solution? Get to 200% of GDP? Lower interest rates to negative territory? I hear from very renowned economists that the solution is to put negative, negative interest rates. We have negative real interest rates right now. No, nominal negative interest rates. Why? Because people are so stupid that they're not doing what the central planners want them to do. They want them to spend and they want them to invest more. And the reason why companies are not investing more, stupid companies that they prefer to buy back stock, is because interest rates are too high at zero. Is because, as a renowned economist said quite recently, is because they know that at some point interest rates will rise, and as such, then they decide not to invest. Do you really think that a company is not investing, not investing, they are all investing. They are not investing what central planners would like them to invest just because interest rates are at zero? There are many other factors, no? If the delta for you to make a decision on an investment is for that interest rate to be at 0 or 1, is a 1% move in interest rates, seriously, you have a very big problem with the type of investment you're looking at. It's a time bomb. It's not an investment. But if the decision to invest when interest rates are at 0 is you will decide to invest not at 0, but yes, at -1%, what kind of investment is that? Think about it for a second. You're a company. You are looking at everything. You're looking at maybe a 20-year horizon in terms of revenues, in terms of risks. You're looking at different numbers of weighted average cost of capital. You're looking at different environments of macroeconomic growth, of inflation, numerous factors. But the deciding factor to invest billions of dollars is that interest rates go from 0 to -1. What kind of investment is that? A time bomb. So this is the perennial problem of lowering interest rates, is that you're not attracting higher productivity, you're not attracting better investment, you're attracting malinvestment. If you think about it, it is no surprise that productivity growth in the main economies has been so poor. It is no surprise that throughout the period of the highest increase in money supply in the United States, productivity growth has been the lowest. It is no surprise that Donald Trump can go to the elections and say that the job market is the worst seen in history at 4% unemployment because labor participation rate is 62%. Of course he can, because there is a reason behind it. So, if we think about the risks, the biggest risk that we face right now is not all of these things. Is that the way to exit is very, very difficult. Is that we don't know what are going to be the consequences of a rise in interest rates. We don't. And by the way, interest rates rise even if central banks don't increase their objective. Interest rates are already rising, spreads are already rising in corporates. Spreads are already rising for families. That is a demonstration that you cannot just keep lowering interest rates forever. Another demonstration is another proof of it is that you cannot put today a solution that if we found ourselves in a big downturn, there is going to be a policy that is going to do exactly the same that we have done in the past and work to get us out of the situation. Can it be higher public spending? Look at the list of countries. 180 countries next year are going to be deficit spending. Look at the amount of government spending that we have seen. There is no surprise that we have such level of overcapacity. More importantly, the other problem that we find ourselves with is that central banks can understand high inflation or low inflation. Central banks can understand the way in which to manage themselves or to circle their way out of a recession, but it's very, very difficult for them to understand or to know what to do in a period of stagflation. What do you do in a period of stagflation? If inflation rises, the economy slows down. What can you do from the current perception, from the current policies of central bankers? Very little. You don't know what to do. Because if you raise interest rates, you're going to be worried about slowdown in the economy, and if you lower interest rates, you don't get any outcome out of it. More importantly, if, as we are hearing every day, every single hour on the news, in the media, everywhere, if today central banks decided to do the opposite of what they say they would do. So now we are supposed to be in a normalization process. What kind of normalization is it when money supply continues to be much higher than nominal GDP growth? What kind of normalization it is when interest rates remain below the curve? It is not normalization. It continues to be a very accommodative policy. Now, the problem that you find yourself as central banks is you cannot solve this situation. Governments will not solve the situation spending their way out of a downturn. They will not, because the level of overcapacity is already too high. See what happened. First, we had overcapacity in the Western world. And by massively injecting liquidity and lowering interest rates, we passed that overcapacity over and increased it in emerging markets. All with the idea of selling more and exporting more to China. And what did China do? The same. So China gets into massive overcapacity and tries to export it to the United States. Okay? And there's a point in which you get to debt saturation. Now, what is the solution? Because there are solutions. There are solutions. The opposite of what governments want to do. Governments think that the solution is to spend a lot more, in government spending, infrastructure, etc., and central banks think that the solution is negative, or at least many of their economies, negative interest rates and much higher liquidity. Well, that only leads to Japan 2.0. The solution is the opposite. The solution is actually to let interest rates rise in order to clean up that part of that malinvestment while there is still a thriving and working financial market that will help to continue to finance the real economy, and for governments to forget the idea of deficit spending and to go back to sound money. And by increasing the purchasing power of salaries and incentivizing saving and incentivizing adequate investment instead of malinvestment and destroying the purchasing power of currencies, what you would actually get is an improvement of the middle class, which is the one that is currently being eroded via constant destruction of purchasing power and constant destruction of the value of money. At the end of the day, it's going back to sanity. But going back to sanity is very, very challenging when many people get a lot of benefit from insanity. So thank you very, very much for coming. And the idea of this book, Escape from the Central Bank Trap, came precisely from the view that there are many books out there and many different writings in which either they say that monetary policy is the worst thing after hell, or that monetary policy is the best thing after sliced bread. None of them. There can be a way in which, without ending central banks and maintaining a system in which there is, wide credit growth, etc., we can incentivize an improvement in productivity and an improvement in the middle class. The first factor is for central banks to add other measures more than inflation or unemployment. Inflation, by the way, CPI inflation, which is what they look, core inflation and index of prices, is not enough. They need to look at market inflation. They need to look at asset inflation. They need to look at productivity growth. They need to look at the type of credit growth that is being generated in the economy. They need to understand that they cannot be incentivizing, for example, that we have constant increases in a level of credit that is fundamentally used for recycling of capital. And they need to be a lot more diverse, a lot more oriented towards the reality of the economy. You cannot just ignore the financial part of the economy. You cannot ignore the financial part of the economy because it is the one that it always comes as the symptom that begins a new recession or a new crisis. You cannot do that. You cannot be as a central bank president or chairman or a member of a central bank and think that low yields and high valuations have no impact on many other assets. Because the more indebted we become, cycles are shorter and more abrupt. And the more that we erode the purchasing power of salaries and savings, the more that the middle classes get more and more angry about the situation. Because you cannot have a system in which the ones that receive the first dollars that are created through money supply always benefit, and the ones that are last to receive those dollars or those euros or those yen are the ones that always pay. That doesn't make any sense. It makes no sense whatsoever. More importantly is that we have reached the level at which it doesn't work any further. We have already seen the impact of negative nominal interest rates in many countries. It's been a disaster. It's not going to be the solution. We have already seen what happens in countries that decide to go even further into government spending and even further into debt. We already know what happens in Japan. Japan, last figure, third quarter growth, negative. Only purchasing 70 billion of assets every month and massively increasing the deficit of the country. And more debt at lower rates is not the solution. Why? Because like Japan, like the United States, it's on its way to spending more on interest expenses than on military spending. In about 5 to 7 years at this rate of deficit spending, no matter what, the 10-year, 30-year yield, the average cost of debt, more or less, even if it remains the same, even a little bit lower, the United States is going to be spending more on interest expenses than on defense. Japan is already spending 22% of its budget in interest expenses. So no, low interest rates, debt does not solve itself through low interest rates. And the fact that interest rates are low doesn't make any debt acceptable, because interest expenses, even if you pay 0.5% or 0.2% for your government bonds, it is still going to create a massive problem. So we need to come back to reality. Deficit spending means more taxes and less growth in the future. It doesn't mean, it's not a tool for growth. It is a tool for malinvestment. Low interest rates don't generate an environment that helps the economy to deleverage. It's an incentive to re-leverage. High liquidity does not make people be better investors, but more careless. Think about it this way. You go 1st of January to the gym, New Year's resolution, you decide to lose some weight, you decide to get healthier, and you arrive at the gym and you see a massive display of donuts with a small sign saying, don't eat too much. What are you gonna do? That is monetary policy. Monetary policy is putting in front of you a massive display of donuts and telling you not to eat them. You're still going to eat them. Who eats them? The one that doesn't suffer from the impact of malinvestment and excess debt. Governments and banks. So we need to do something to put at the forefront of policy not the ones that benefit from doing things badly, but the ones that benefit from doing things correctly. There is a way of getting out of the 20 trillion monetary hole, which is by going back to supply side measures, not to demand side measures, by going back to sound money and by recovering sanity. That is what we need to do. Thank you so much. Thank you so much for coming. Thank you very much. And if you have any questions or any comments, we can open the debate. Yes?
Thank you for your comments. I have a lot of questions. I'd like to focus my first sort of line of questioning, for lack of a better term, on Europe and the ECB, since that's not something that I'm really, I don't live there.
Yeah.
I've effectively never been there. So one of the things that I believe you mentioned was financial asset inflation. Now, to me, and please tell me if I'm wrong, the financial asset inflation in Europe is in the bond market.
Yeah.
It's in sovereign bonds that in countries that don't keep their economic house in order,
Yeah.
yet those bonds yield less than the 10-year US Treasury. I don't believe that there's financial asset inflation in European stocks, for example, and I would use, one of my favorite stocks as an example, that is Nestle, the Nestle company. I don't think of Nestle as being artificially inflated.
Yeah.
Okay. I think it was a company that makes a lot of money.
Yeah.
Sells gold.
Yeah.
And trades at a reasonably cheap valuation.
Yeah.
So my first question really is regarding these incredibly low yielding bonds. It's really a two-part question. Who buys these bonds? Or who would buy a negative yielding bond besides the ECB?
Yeah.
Because to me, the ECB's, to use an American term regarding a vacuum, they're hoovering everything up.
Yeah.
I don't think a real investor, correct me if I'm wrong, is buying a bond that yields negative 20 basis points.
Yeah.
So that's my first question. Who's buying the negative yielding bonds besides the ECB?
Yeah.
And ultimately, if the ECB is really the end buyer,
Yeah.
who suffers? Ultimately, the ECB is going to suffer because if there's ever inflation, the value of those bonds will plummet. But the ECB will just cover their loss by printing more money.
Yeah.
And we haven't seen a limit on that yet, I don't think.
Yeah.
I think you're saying there's going to be one.
Yeah.
Can you comment?
Okay. So starting from who buys these bonds. Currently, the ECB is virtually the only buyer of these bonds, and the financial institutions that buy these bonds actually buy them because they know that the ECB is going to buy them afterwards. The ECB has been the only buyer of Italian bonds in the last months. No? So there is no secondary market demand for most of the Eurozone bonds at all. You ask anyone who would buy Portugal 10-year bonds at 1.5, 1.6%. If the ECB wasn't there, you won't see a single hand raised anywhere in the world. So that is a that is a bubble. Now, what is the difference between the ECB and the Fed, for example? At the peak of QE, of quantitative easing in the United States, the Fed was never 100% of the demand of treasuries. So they always had an eye on the market. There was always some secondary demand there. Secondary market demand. That is not the case either in Japan nor in Europe. So that is a big problem because that is uncharted territory. We have no idea whatsoever of what would be the yield at which real investors would accept 10-year Greek, Portuguese, Spanish, Italian, French, Slovenian bonds. We have no idea. And that is a big issue. You were saying before something that I think is very interesting, and that actually is part of the excuse of the ECB. When you say to the ECB that there's massive inflation in financial assets, they tell you no. Look at the Eurostoxx. The Eurostoxx index is actually doing quite poorly. Is actually not going up. It is one. We have to remember this. Asset inflation does not mean multiple expansion always. It means keeping those multiples where they are. So, for example, do you think Eurozone banks trade at 12, 14 times PE? Now, would you really pay 12, 14 times PE for stocks that have not generated organic growth in the last 12 years? So what the ECB has done is effectively, it has not made asset prices balloon, but it has kept multiples at a probably unjustified rate. Maybe not Nestle. You're probably talking about a company that is much more difficult. And the reason why the European Central Bank or the Central Bank of Japan fool themselves with the fallacy of, hey, we're printing 70 billion, but the Nikkei is down 9% on the year, is that what they do is actually keep multiples elevated. They don't raise them. What happened in the US? In the US, in the last 8 years, you had on one side the expansion of the balance sheet of the Federal Reserve, and you had very low rates and very high liquidity. But on top of that, US companies do one very important thing that neither Japanese nor European companies do. They buy back shares, and a lot, to the point that last year, the biggest buyer of stocks in the United States were the companies themselves. So that actually makes multiples expand a lot more because your earnings per share is actually the share count is being reduced constantly, and there's less shares in the market. Funnily enough, in Europe, throughout the period of the ECB expansion, many companies, what they did was to actually increase the share count by paying dividends in shares, by doing scrip dividends, things like this. So what that ended doing was compressing multiples. But that doesn't mean that it has not created elevated multiples in other areas. For example, private equity. For example, you have seen the multiples paid for infrastructure assets in Europe multiplied by 5. By 5, because a lot of the money went to infrastructure that was actually more attractive than indices in Europe, in which the companies are basically mega cap conglomerates with very little growth. But if you look beyond those indices and the banks, the utilities, and the telecoms that actually saw the multiples compress, you have seen other companies from other sectors go through the roof. By the way, including companies in the consumption, in the consumer sector. So the point is, yes, the ECB is also generating massive inflation. More importantly, the ECB is creating a much worse type of asset inflation, which is that of sovereign bonds of countries that have very little credit responsibility. And what has happened, and we are seeing it right now with the debate with Italy, with Portugal, with Spain and others, is that what they're doing is they want to increase their deficit spending, and after massive, in Europe they talk a lot about austerity, we have seen very little austerity. So it becomes a perverse incentive. But again, the ECB is not conscious about the lack of demand in the real market for their bonds.
So you're saying that at the higher levels of the ECB, I mean, I assume these guys are very smart.
Yeah.
These guys don't have much of a conception of that, hey, if we weren't buying Portugal at 1.6%, they don't have a conception that there's no other buyers out there? I find that a little hard to believe, don't you?
I find it hard to believe until I speak with them.
Okay, so you speak to
them. Because when you speak with them and you say, look, there is zero real demand in the secondary market for bonds of the Eurozone at these yields, then they say, but we can do a TLTRO, target liquidity, that would keep bond yields low. You see, they're not denying, but they're saying that they have tools to keep the yields low. For example, they're talking about an operation twist right now. An operation twist, for those who don't know, is basically that everything that matures, they buy it back. So in essence, what they detract is bonds out of the market, and they force you, the lowest risk investor, to buy the remaining, so only what countries deficit spend, no? So only financing the deficit. But in reality, they also believe and that the Eurozone is in much better shape and these countries are in much better shape, and that actually investors would be interested in buying those bonds. And it's a debate that is ongoing all the time. Yeah, sorry.
Do you think though part of that's just they don't want to admit that they were wrong? It's kind of like those scientists used to say eating meat is bad for you, and then they just kept going with it because they didn't want to ruin their careers at a certain point.
I don't think so. I think that they genuinely believe that the Eurozone has improved significantly, and that they genuinely believe that Greece has exited successfully the bailout program. They genuinely believe in the Portuguese quote-unquote miracle. I think that they genuinely believe that things are much better, and they actually do say a lot of times that that there is a view that it's speculators that see things in a negative way. I think that I think that they have the members of the European Central Bank are correct in saying the Eurozone, in terms of its imbalances, is better off today than it was in 2011. True. But bond yields are a fifth of in some cases, of what they were at the time. So this is what you see, in general, not in general, I would say widely, in central banks, understanding risk and valuations of markets is frowned upon. So when people like Carl Icahn, like Peter Schiff, like so many others talk with them and they say, don't you see this massive problem here? They're sort of like, we talk about inflation. That is the problem. Not paying attention to. Just a question to the people here: who has ever heard any central banker while in office say, afterwards they always see it, say that markets are too aggressive, are too aggressively priced? Never. A new paradigm, blah 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 blah. Never. Once they're out. Once they're not in the Federal Reserve or in, they do see it. They do see it immediately.
Alan Greenspan did ask the famous question, when do we know when we're in irrational exuberance?
Yeah, he did, and he lowered interest rates to 1%. You see? No, I mean, at the end of the day, to think about it from a negative perspective is easy. But to think about it from their perspective is much more complicated. What is their perspective? The perspective of, let's say, lesser evil. What is worse? That markets go through the roof, or that unemployment increases by 1%. So it's a lesser evil way of behaving. But that sort of works for a period of time. But then it gets to a point in which the perverse incentive is too high. You know what I mean?
And you mentioned that the policies today are obviously hampering growth. I should say obviously, but I agree with that view. What do you see as potential paths forwards from a policy perspective to sort of get onto the right track? Is it even possible?
Well, I think that the first part of it is, let's say something positive, no? Yeah. I think that the current chairman of the Federal Reserve is doing quite good things, because instead of panicking and changing policy because the European market is down, or because Apple falls in the stock market, because the iPhone sales are lower, he's actually data dependent. Being data dependent is the beginning of the solution. In the book I talk about a Taylor rule. You don't have to follow exactly a Taylor rule, but you do have to be data dependent. Because think about this: if you say, I am going to increase rates when inflation is at 3% and unemployment is at 3%, and you don't do it, what are you saying to people? Party. You're not saying to people that you're saying two things. One, I know something about the economy that is much worse than what you think. Second, you're saying, be crazy, go crazy, break a leg. That's what you're saying to people. So you have to be a lot more data dependent, and data dependent includes stock markets, house prices, etc. You cannot say there's no inflation because we took housing out of the equation to calculate inflation. That's ridiculous. That's cheating, no? to a certain extent. You need to be a lot more data dependent, in my view. Yeah.
Monetary, I'm going to make a statement.
Yeah.
Monetary policy operates with long and variable lags.
Yeah, absolutely it does.
So today,
yeah.
And I wasn't going to touch the U.S. so much because I have more questions about Europe.
Yeah.
But monetary policy operates with long and variable lags. So there are signs today, I believe, that the increase in interest rates is having some impact on the housing market. And I'm not talking about housing prices.
Yeah.
I'm talking about housing as a percentage of GDP. For example, today, I believe it's the NAHB, the National Association of Home Builders survey came out. It was expected to be 68. It was 60. So what the markets are calling for, and I'm not saying the markets are right, okay? The markets are saying, well, geez, you know, the Federal Reserve's interest rate increases are starting to bite this sector of the economy. But they're going on and continuing to increase rates. So our concern is that the rates that are already in place and the lag that it operates with is going to have a serious impact on real GDP growth.
Yeah.
So that could be, I'm not saying this is not my argument, that could be an argument for Jerome Powell to tighten in December and say, okay, now I have to wait for a little bit, I have to assess that lag.
Yeah.
Your thoughts on that?
Monetary policy works with a lag. Absolutely it does. Now, the question is whether you understand that the impact on housing is a negative impact or it's a healing impact. Okay? Whether you want to create a bubble or inflate a bubble or whether you want to cool it off. Now, what I would argue if I were at the Federal Reserve would be, hello, I would be very concerned not about the housing index going from 68 to 60 because interest rates are going up. I would have been extremely worried of it going to 68. See what I mean? Mm-hmm. The problem that, you know, we tend to ignore, we see that this is going to be a drag on growth, but we didn't see that it was probably a drag on the next bubble, no, or creating the next bubble. So the risk so the way that I would see it is, hold on a second, where did it go to? What did it do? I think that the housing index has risen 300%. If I'm not wrong, I don't have the exact figure, but about
coming from very depressed levels in 2008.
No. Already post recovery, 2010. From 2010, 2011, I think it's gone up dramatically. I don't even know the figure, but it's gone up dramatically. While real wages have not been increasing significantly, while at the same time the many other variables that sort of drive home prices and the affordability of homes have not improved that dramatically. So something is a problem there. So I think that the way in which the Federal Reserve should look at these things is, first, what is the percentage that housing means relative to the GDP? Well, it's definitely a third of what it was in 2008. That's a good thing. So if there is a cool off if there's a cooling of the housing market, that's not a bad thing. That is not a bad thing, because the type of buyers that you're going to be attracting are going to be stronger buyers. You're going to be, because let's face it, if your ability to repay a mortgage again fades because of 25 basic points, we have a problem. No? That is similar to what is happening in Europe. When you look at credit growth and you see, oh, credit growth is slowing down, is that a bad thing or is that a good thing? It might be a good thing, because if credit growth was rising because, you know, there was, again, massive inflows into housing, or because there were massive borrowed investment into infrastructure at ludicrous multiples, then it's not a bad thing that it cools off. So, you see, that's why I think that they need to be more data dependent, and they need to be they need to go from GDP and inflation to more granularity. And I think that that has to, I don't think that the US economy was supposed to enter into recession 2 years ago, according to every Keynesian and every consensus analyst, because the Federal Reserve stopped buying 2 years ago, and because interest rates started to go up. And guess what? It's growing more. It's growing 3.5%. I remember I was on TV talking about it, about growth of 3.5%, and they said it's ridiculous. It's impossible that the economy in the U.S. grows at 3.5%. Well, it did. So a lot of things are actually going a lot better as well. And that's what you need to sort of balance, no? And that's what needs to happen in the Eurozone, in my opinion. Yeah.
Kind of a two-part question. So I guess the first question is kind of related to what you talked about near the end with the stagflation, but sort of related, I guess. Do you think the United States could ever have some kind of currency crisis? Because you see things like in Argentina and Turkey where they're having these crises, and we have almost very similar policies, with the only difference being that we're the reserve currency, I guess. And I guess the second part of the question is, why is it that the dollar is still sort of seen as like this safest asset, that like when there's turmoil, like people just jump to it, even though again we have these like almost the same policies as countries which are having these crises?
The first, being a world reserve currency is not something that you can decide as a government. You become a world reserve currency not just because of your monetary policy, but as a relative to others. The first thing that I would sort of completely actually disagree with you is that the United States follows the same monetary policy as Turkey or Argentina. No way. No way. What Argentina does is massively increase government spending, finance government spending by printing pesos, giving those pesos to the public servants, and the public servants, the first thing that they do with those pesos is run away and exchange them for anything. I had a friend who got robbed in Buenos Aires, and they took the watch, they took a couple of other things, jewelry that he had, and he was going to give them money, and they said, "We don't want it." Yeah, the thief didn't want pesos. Keep them. So this is not a joke. So the United States doesn't follow the same monetary policy. Why? Because there are other factors that make you a world reserve currency. One, and very important, is investment security and legal security. The reason why the U.S. government can deficit spend and attract more investment from the rest of the world that prefers to buy those bonds rather than buy bonds of Turkey or of Argentina is because investment in legal security is much higher in the United States. So economic freedom, legal security, investment security, critical factors. That's why the yuan will never be a contender for the US dollar, because you cannot have a world reserve currency and capital controls. It's impossible. That's why this debate that I hear all the time that the yuan is going to destroy the US dollar it's impossible. The first reason, you know why, is because the Chinese don't want it. The first people, if you're an American, you're all over the world, and I give you euros, I give you pesos, I give you bolivares, I give you yens, whatever, you want dollars. Now, you're a Chinese guy, and I give you yuan or euros, you prefer euros, and in general. And why? Because you know that the monetary policy process of the United States is a quid pro quo process. So it's not just for the benefit of government against savers and salaries. It is to slowly reduce the purchasing power of salaries and savers, because you have the opportunity and the option of making a lot more in different assets, in growth, in your own economy. It seems simple, and you say, well, why doesn't everybody do it? Very simple, because when the incentive is so tilted towards government, citizens will always look for any other option in any other currency. And as such, the game of currencies is always a game of relatives. Obviously, you have gold, no? But you know, in a world that doesn't sort of disappear into oblivion, the world of currencies is a game of relatives, and as such, you will always prefer the one in which you have more legal, more investor security, and more saver security. That's why the yen, despite the government doing all the crazy thing that it does, is sort of a safe haven, because it's a game of relatives. And why? What the yen, the pound, and the dollar are net inflow generators of investment. So the Japanese people bring their currencies from all over the world to Japan. The British people, you know, they bring investment all over the world to their country. The US does the same. You become more attractive. Now, that can end if things that I hear out there many times in this country, no? If the government decides, well, it's going to go on forever, so I might as well go crazy, then it breaks. So being a world reserve currency is a very, 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 very thin ice sort of dance. And you have to tread it very, very carefully, and you have to maintain being the world reserve currency. That's why when I hear all these voices saying that the U.S. that the Federal Reserve needs to do more to devalue the dollar, that they need to print more, etc., say no, it's the opposite. You need to keep the dollar strong in an environment of slowdown, because if not, it is going to be very easy for the world to turn against the world reserve currency.
Do you think that if Japan and like the BOJ have like big issues coming in the future, that could be a catalyst for the U.S. dollar losing a lot of its value because they own so many treasury bonds? They might have to stop buying them or start letting them expire, or just even start getting rid of them.
Japan?
Yeah, because they're, I think, the second largest holder.
The largest foreign holder of treasuries is currently Japan, then China. But for them, U.S. treasuries are an asset. And part of the reasons why their currency does not devalue dramatically and go worse is because those treasuries are actually an asset that is valuable for them. Now, the Japanese and the Chinese are the biggest foreign holders of U.S. treasuries. The biggest holders of U.S. treasuries are the U.S. citizens. The biggest holders of U.S. treasuries are the Social Security, the pensioners, the financial institutions, the Federal Reserve, etc., etc. And only marginally at the end of all of that, you start to have the foreign buyers. Foreign buyers are good, but they don't dictate where treasuries go. I heard for years that the Chinese were going to sell down their treasuries and that would cause a debt crisis in the US. Well, the Chinese have sold a big chunk of their treasuries. A, it has not created a big crisis in the United States. B, more important, what it has created is the yuan to 7. Sorry, when I say like this, it means devalue. It has devalued, and it continues to devalue constantly, because obviously there are capital controls and it's controlled by the government. The government dictates where the fixing is, but so it has caused the opposite effect of what many people sort of expected. No, yeah.
Last question, I'm sorry to hog the floor, I promise it's my last. More of a pure economics question. To some degree, you've interchangeably compared the financial, the problems, particularly as it relates to central banks of Japan, Europe, and the United States. Is it fair to do that when at the end of the day, Japan's real problem is demographics?
Yeah.
And they don't have any growth, so that's what's really kind of, putting the hurt on them in regards to to what
Absolutely.
the bank has to do.
Completely true. The big problem of Japan is demographics. But the problem but instead of saying, hey, we have a demographic problem, I think that Japan has lost about 1 million citizens, and at the same time, not just losing number of citizens, but aging population, phenomenal. Okay, so instead of trying to print your way out of fundamentals, you address fundamentals. No? So maybe the demographic problem cannot be sorted out, but you can address it by increasing productivity. And you can address it through supply side measures. The idea, and this is, and by the way, this is where Europe is going, because Europe has a similar demographic trend to Japan, and many countries actually worse, in many countries in Europe. Instead of saying, oh, I'm going to print my way out of fundamentals, out of demographics, out of productivity, address those issues of demographics and productivity through supply side measures. Instead of saying, look, you evil people are not having children and we are not attracting citizens, no, do something about that and do something about productivity. But yes, of course it is. Of course, but the central bank is not going to solve that situation by generating massive liquidity injections into the economy. Furthermore, even if you thought that there is some way in which you believed that the central bank is sort of helping sort out that problem, definitely not buying equities. Somebody has to tell me, even from a Keynesian perspective, what the hell is the Bank of Japan doing buying 40% of the ETFs of the country and being a top 5 shareholder of the Nikkei companies? That has absolutely nothing to do with addressing demographic or productivity issues, and certainly shows that what their true interest is asset inflation. Because why would you buy equities, to be fairly honest? Because you can, in Japan, so you can say to have more influence on the companies. Sorry, in Japan, I don't buy that. In Japan, the government and the big companies are almost intertwined, not to say interlinked.
What would be one example of a measure to address productivity?
The biggest measure to address productivity?
One example.
One example, the easiest. Stop subsidizing low productivity sectors and penalizing high productivity sectors with higher taxes. That's the way actually in which the US started to improve its productivity growth was actually by doing that. If what you do is via monetary policy and by fiscal policy subsidize the low productivity sectors, the obsolete sectors, and at the same time, in order to finance the deficits, increase taxes to the high productivity sectors, you can't even start to debate. Productivity growth is going to collapse. Because money velocity also collapses, no? Very good. Well, thank you so much, everyone, for your questions and for being here. And I see pizza. So thank you so much. Everything is good. Have a good night.